I've entitled my presentation this afternoon, Gold versus Government. And as I work through this presentation, you'll see why I've chosen that title. Essentially, that's what GATA is all about. It's exposing, explaining, providing information about what's been happening to our monetary system over these past several years, and particularly the suppression of the gold price. There's an old Chinese saying that says, wisdom begins by calling things by their right name. So I want to start by going back and using the proper terminology and explain why gold is not an investment, but gold is money. If you accept the government point of view that gold is an investment, you're already starting on the wrong track, and you're going to lead to bad conclusions and wrong answers. If you start with the premise that gold is money, you're going to end up on the right track to understand what gold is all about and why gold and governments compete with one another. This is probably the most important chart I'm going to show today, and I'm going to lead with it in order to make this point about calling things by their right name. This is the price of crude oil, and I'm going to show it in two different currencies. This is a base 100 analysis starting back in December of 1945. And it shows what's happened, this blue line shows what's happened to the price of crude oil in terms of dollars. It's gone up approximately 90 times in dollar terms from its 1945 price. Now what I'd like to do is put the price of crude oil in another currency, and it's that red line across the bottom. That's the price of crude oil in terms of gold. You can see that the price of crude oil has not really essentially risen at any time over these 6 decades, but the price of crude oil has gone up in dollar terms. Now, this explains not only why gold is money, because it's very useful for economic calculation. In other words, it's very useful in determining the price of goods and services, particularly when looking at them over long periods of time, and that's the essential nature of money. But this chart is also important because it shows why gold is not an investment. In other words, 1 ounce of gold today buys no more crude oil than it did 60 years ago. Who wants an investment like that? It's a lousy investment because you're not getting any appreciation on the purchasing power of that 1 ounce of gold. You're getting essentially the same amount of purchasing power on that 1 ounce of gold, and that's what makes gold money. I think it was Reg who explained this morning that unless you put your money at risk, you should not expect a return. And that's where the difference between investing in gold and buying gold as money is so important. Gold is money because it's useful in economic calculation, and it does not have counterparty risk. It's a tangible asset. It's not dependent on anyone's promise. And consequently, you shouldn't expect a return from that, but you should expect consistency in purchasing power. When you talk about gold being an investment, and like last year it was up 31%, it's not really an investment because there's no appreciation in the value of gold. It's depreciation and debasement of the dollar that causes the gold price to go up. So gold is going up in dollar terms only because the purchasing power of the dollar is going down. Now this principle of looking at the price of goods and services in terms of gold applies not only to crude oil. You can apply it to essentially anything. There was a book that came out 20 years ago by a professor at the University of California called The Golden Constant. The professor's name was Jastram, J-A-S-T-R-A-M. It's still available in bookstores if you're interested. He did an analysis of goods and services, basically goods, commodities prices, over 500 years of British monetary history. It showed that essentially a bushel of grain, when he began his analysis 500 years earlier, cost the same amount of gold as it did when he was doing his analysis 500 years later. And the question is, why does this happen? And in order to understand why gold has this consistency in purchasing power, you have to sort of step back. You have to look at the big picture and understand that gold is different from everything else we humans produce. Gold is accumulated. Everything else we produce, soybeans, crude oil, you name it, they're all consumed. So the amount of above-ground crude oil, the amount of above-ground soybeans are relatively small because they're consumed and there's no advantage to having huge stocks. But gold, on the other hand, is accumulated. So all of the gold essentially mined throughout history still exists in its above-ground stock. And the answer is, well, why? Why do we accumulate this? Well, it's really very simple. Why do things have value? They have value because they have usefulness. And gold's usefulness comes from the fact that it is very good in economic calculation. In other words, it is money. So gold is sort of a natural form of money that over centuries and centuries and thousands of years of human involvement and commerce and acting in a society with one another, we've come to accept that gold works very well as money. And it works for a very simple principle. The consistency and purchasing power of gold occurs over long periods of time because the amount of new gold production, this huge above ground stock of gold, it grows by about 2% per annum at most, which is approximately equal to world population growth, which is also approximately equal to new wealth creation. So there's this consistency in supply and demand of gold over a long period of time. It's a very natural form of money. Now, it's a natural form of money, but the last 100 years or so, we haven't used it as currency. And that's a whole nother issue, because money and currency are different things. Money is this mental tool that we use for economic calculation. Currency is what we use from hand to hand. And if you go back to looking at the classical gold standard, you understand the difference and the important difference between gold on one hand and currency on the other. And this gets to the heart of the argument between gold versus government and why they're in competition with one another. If you look at monetary history, money does the same thing today it did thousands of years ago. It communicates value like it does in this chart. Currency, though, changes, it evolves, it becomes more efficient. And that's sort of natural because technology is applied to currency just like it's applied to other forms of human effort. And we want currency to evolve because if we can reduce the costs of transacting with one another, we're actually creating more opportunities to interact in a form of commerce. And that's good because the more opportunities to interact in commerce, the more goods and services we humans are going to produce to raise our standards of living. So you don't want to impede with currency. You don't want to impede with its technological improvements. It started out currency first started out, trading cows and things of that nature, and then it evolved to small coins, which were very rudimentary. Eventually, somebody had the idea of milling the edge of a coin. It was another technological improvement in the form of currency. Then there was a fundamental change in 1694 with the creation of the Bank of England. Currency changed fundamentally because up until that moment in time, currency was always a tangible asset. And you were exchanging a tangible asset for some good or service. So assets were being exchanged for assets. But the Bank of England said, well, this is too valuable to move around, and it can be a little bit cumbersome because international commerce was growing, starting to grow, the exploration of the New World. And they didn't want to ship all this gold and silver all around the place, so they created the idea of using a banknote, a piece of paper, and using paper as a form of currency while the gold and silver remained in the bank vault, which was a technological improvement, but it altered currency. Instead of being a tangible asset, it now became a liability of a financial institution, and currency was forever changed. We've been using liabilities of a financial institution ever since the Bank of England was formed, and tangible assets like gold and silver coins have all but disappeared from circulation. But I think technology is going to change that again in the future. But more importantly, you have to understand that what we're using today as currency is not money. It's a money substitute. And that money substitute comes with a lot of risks. It comes with risks of mismanagement from government. It comes with risks of inflation. It comes with counterparty risk that the person whose IOU note is written on there is not going to preserve the purchasing power of that currency or honor it. Or when you go into a store, that whoever's going to accept that in payment for goods or services is going to accept it. And that creates a lot of problem. And that gets to the heart of this gold versus government issue. When the Bank of England was created, in 1694, the first banking crisis occurred in 1696. Too much currency was issued. And this has been the problem with money ever since. So at the time, if you're familiar with British history, William and Mary were on the throne. They were fighting the Jacobin Rebellion. Louis the 14th was gearing up in France for more battles and whatnot. And the British monarch was essentially penniless. But he realized, the monarch realized that currency, this paper note that the Bank of England created was good, but there were a lot of problems. So he did what any monarch did. He got the smartest person of his day to come and talk to him and solve the problem. The smartest person of the day was Sir Isaac Newton. And Newton looked at the problem, and eventually he's the one who created the classical gold standard. Under the classical gold standard, it was a voluntary system, and it worked beautifully as long as people followed the rules, as long as central banks followed the rules. In other words, they could only issue so much currency. There was a certain amount of discipline imposed, because if they issued too much currency, they would have a bank run. Also, in terms of international payments and stuff, money would flow back and forth. And given the Newtonian physics of the day, it's quite understandable that he would create a system which sort of naturally balanced itself. If you've heard Greenspan talk very fondly about the classical gold standard in testimony before Congress, he talks about the automaticity of the gold standard, and this is what he meant. The reason why we have sovereign wealth funds today is because there is no automaticity in the monetary system. It's a creation of fiat currency. There wasn't such a thing as a sovereign wealth fund 100 years ago under the classical gold standard, because it wasn't possible. But the key to the classical gold standard was that central banks were managing their currency in order to be consistent with the ongoing consistency in gold's purchasing power. But 100 years ago, banks realized, and governments more importantly realized, that if they didn't follow the rules, they could manage and manipulate the currency system to their own advantage. So what they started doing is, instead of managing the currency to fit the purchasing power of gold, they started managing gold in order to fit what it turns out to be the ever-diminishing purchasing power of a unit of currency. And this is the essence of the gold cartel, and why gold and governments are in conflict with one another. This natural form of money that people hold because of its usefulness without force or coercion versus this artificial form of money that governments create out of thin air, which people hold simply because of fiat currency legal tender laws and other factors that contribute to this forced circulation of the currency. That is the essence of the argument, and this is the whole essence behind why gold and governments are in competition with one another. Having laid out that sort of lengthy background, let me get into some of these other charts, and it will build upon these basic points that I've just established. The key, remember, on the gold standard is discipline. There is no discipline in today's monetary system, and this chart explains why. This is the quantity of money, M3, and this is the annual growth rate at each month end, plotted since the mid-1970s. And you can see that in the 1970s, we had double-digit rates of inflation because we had double-digit rates of growth in M3. The total quantity of dollars was increasing at such a rate, far above the 2% rate that gold increases, and it inherently was inflationary. Inflation is a monetary phenomenon. When Volcker came into the Federal Reserve and given the mandate to save the dollar, he did what he had to do. Over a period of time, he slowly, by taking various actions, raising interest rates, which is the exact opposite of what Bernanke's doing, slowly but surely over a long period of time reduced the growth rate in M3 all the way to September of 1992. You see that little dip below the zero line. That's significant because that's when George Soros broke the Bank of England. Because the dollar is the world's reserve currency, the disinflationary policies of Volcker, which Greenspan continued when he was appointed in 1987, were being exported to the rest of the world. And as a consequence, this disinflation in the US was also being imposed in other currencies. And the exchange rate mechanism that was then in place was in a disinflationary mode as well. And Britain and Italy had enough of it. They had enough of the disinflation. They broke away from the exchange rate mechanism and started reflating. And it led in, not only in Europe, but the rest of the world, as the Federal Reserve joined the bandwagon, a huge reflation. But all of these new dollars being created in the 1990s did not go into tangible assets like they did back in the 70s. They all went into the financial assets and into the stock market, and this is what created the stock market bubble. Then, after the peak in 2000, we now had another downtrend line, which I call the flight out of the dollar, and I'd like to make an important point here. This talks about the quantity of dollars. We tend to ignore something that's just as important, if not more important, which is the demand for dollars. Money, like any good and service, is a function of supply and demand. And here we had an environment which was exactly different from what happened with Volcker back in the 1980s. As he was clamping down on M3 growth, the value of the dollar relative to other currencies was rising very dramatically. You may remember that you could get 290 Swiss francs for the dollar, back during the early years of Reagan's administration. But here, under the early years of Bush's administration, as Greenspan was clamping down on M3 growth, In fact, the dollar was declining relative to other currencies of the world. So what we know is that the demand for the dollar was declining more rapidly than any reductions in the supply of dollars. And when you have a situation, any good or service, where demand is going down, that product becomes cheaper and cheaper, which in terms of money means the purchasing power of the currency becomes less and less. So you had what I call a flight out of money. And all you had to do is pick up the paper any morning and find out which central bank was diversifying that day, or breaking the link to the dollar, or which sophisticated investor like Sir John Templeton or Warren Buffett was exiting out of the dollar and diversifying into foreign currencies. All of those things together were anecdotal pieces of evidence suggesting that the dollar was declining. Now, if you see over here on the right side of the chart, this actually stops in February of 2006. And the reason why it stops there is because the Federal Reserve stopped reporting M3. I wrote about it at the time. The article's still posted on the Kitco site. I said that the reason why they're not reporting M3 anymore is because they don't want you to know what's coming. It was really quite, hilarious, the excuses that they gave for stopping to report M3. Nobody follows it anymore. The banks, which make $100 billion a year, are going to save $1 million in expenses. I mean, it's completely trivial and completely laughable, the excuses, particularly in view of the fact that the European Central Bank at the same time was saying that M3 remains then and still remains today an important tool in the arsenal of central banks. So look what happened to M3. These numbers are reported by John Williams of shadowstats.com, which does a great job. It's what I call the Bernanke inflation. We're now growing M3 at 17.4% per annum. This is the highest rate of dollar growth in history. You take this kind of growth in M3 with the declining demand for the dollar on the other side, are we really surprised that the dollar index is down at 71.5? Are we really surprised that gold is where it is? Well, we're surprised because it's not $2,000 an ounce. But my point is that clearly gold is in an uptrend when the dollar is in a downtrend. And you look at these kinds of numbers, it's very understandable and very logical. It's purely numerical. And in contrast to gold, which has the steady 2% increase in the above ground stock, look at the above ground stock of dollars growing at 17.4%. And ask yourself, do I want to hold for my liquidity some of this above ground stock of dollars, which is subject to the whims of politicians and central bankers, or do I want to hold some of this undervalued gold as my liquidity, which is not subject to the whims of central bankers and politicians, and make the decision? And what's happening is more and more people are choosing gold rather than dollars. The demand for gold is going up while the demand for dollars is going down. The net effect is the exchange rate between the two is changing. So the central banks are fighting a losing war. They've won occasional battles, like this morning, they made the gold price go down. They tried to keep it under $930 for a while, and they lost that battle. In fact, they've been losing battles ever since $250 an ounce. And they're eventually going to lose the war, but they're not going to give up because their whole system depends on keeping a cap on gold. Because by keeping a cap on gold, they're making the dollar, in their view, look better and making the dollar look like it's worthy of being the world's reserve currency when everybody here knows, in fact, including themselves, they know, in fact, that it's not. But their lives as central bankers depends upon it, and the system that they support and serve depends upon it. The impact of this monetary growth is not too surprising, as I mentioned. We had, this is the US dollar index, which is a basket of currencies. During the end of the Reagan era, when they artificially were talking down the dollar from the Plaza Accord and the Louvre Accord, the dollar index was declining. Then you had the strong dollar policy under Rubin, when the dollar was rising to the peak in 2000. We've had the flight from currency under the Bush administration, and this is the alarming thing. We're in uncharted territory. The dollar has never been this low before. And if you've seen my latest alert on the Gold Money site, I'm expecting a severe monetary crisis this summer. It should not be a surprise if you've read my book, The Coming Collapse of the Dollar, or the paperback version, which Doubleday released earlier this year, where they took the word coming out because of what's happened. They now call it the collapse of the dollar. So it should not be a surprise that we're headed that way. The only surprise might be that I think it's going to happen this summer. And who knows what's going to happen, but if you're not prepared, I think you've got another maybe 3 more months to prepare for. The flight out of the dollar has also been reflected in various commodity prices. If you look on this chart, see the dotted line on the left-hand side? This was the late 1960s. There was a period of stability in commodity assets. Prices got out of whack. Financial assets were way overvalued. The stock market was at a peak. Commodities were low. Monetary problems started developing. And you had this big, huge surge in inflation in the 1970s. Now look what happened during this disinflationary period of Volcker and the early years of Greenspan. Very, very similar to what happened in the 1960s. And look what's happened since then. We have this huge 2000 inflation. Now, I've been following this chart for some time. And if you've heard me speak over the years, you've seen this blue line on the right-hand side of the chart go higher and higher. And one of the consistencies that you've had is every one of these little dips, you can barely see them on the chart, is everybody's calling the end to the commodity bull market. If they're doing that, they don't understand the real problem. It's not a commodity bull market that we're experiencing here. It's a dollar bear market. Just like there's a flight out of goods and services, you can also do that in terms of not only tangible assets like commodities, but financial assets like the Dow Jones. This is the Dow Jones going back to 1913, which was the year the Federal Reserve was created. And you can see the price of the Dow Jones not in terms of dollars, but in terms of ounces and gold grams. And you have a red line at the peak, and where the Dow Jones is expensive and gold is cheap. You have a green line at the bottom, where Dow Jones is cheap and gold is expensive. So the key to this chart is people say, well, if I buy gold, when do I sell it? Well, the answer is when you get the next cycle. Back in the 1930s, the Dow, believe it or not, was 34, and an ounce of gold was 35. In 1980, the Dow was 800, and an ounce of gold was 800. So you have this one-to-one relationship when an ounce of gold buys the Dow. So the answer is when I get rid of my gold is when 1 ounce of gold buys the Dow Jones Industrials. Now the answer is, the point is the Dow going to be 10,000? Is it going to be 3,000 if there's a massive deflation? Or is it going to be 25,000 or higher if there's a massive inflation? In other words, 25,000 on the Dow and 25,000 on an ounce of gold. I tend to think, based on what we've seen, Helicopter Ben is going to make sure that we have a massive inflation as a way of enabling the U.S. government to get out of its huge debt burden. So I think we're going to see much higher prices than when I first started talking about this chart in 2003. You may have seen my article in Barron's when I said it was going to be 7,000 on the Dow and 7,000 on the gold. I think it's going to be at least twice, maybe 3 times that before this stuff plays itself out. So, there are times when you want to own stocks and there are times when you want to own cash. We're in one of these moments when you want to own cash, but not dollar cash, you want to own gold cash. Keep your liquidity in gold until you have 1 ounce of gold buying the Dow Jones Industrial again. Get rid of your gold, buy the Dow, and ride the next cycle. That, of course, excludes mining stocks, which I've been very bullish on and remain very bullish. More on that in a second. Let me just show you these charts. 3 clear cycles. We're still near the top rather than the bottom, so I think this still has a long way to go. Gold up, Dow down, before we get to the stage where the Dow is cheap and gold is expensive relative to each other. Now, just like we did this in terms of gold, we can also do this in terms of the mining stocks, and this addresses the question that came up earlier this morning. You can have a high point and a low point. At the high point, this is the XAU Mining Index, which is the Philadelphia Stock Exchange Index. You have a clear selling area, and you can see back in the 1996, 1997, that was a selling point. Bre-X, and you remember all that stuff from back then, that was the end of the speculative bubble. And then look what's happened since then. And there's one thing I'd like to point out on this chart. There are 3 clear levels here. That was just before GATA's Durban conference. That was just before GATA's Dawson City conference. And so is GATA doing a good job or not? Let's hope, anyway, huh? But I think there's a clear message in this chart. The mining stocks themselves are cheap relative to the product they produce. So when you take dollars out of the equation and look at it in terms of real money, you just see how cheap these stocks are. So while we're bewildered that the mining companies, majors as well as the juniors, are just getting beaten up and beaten up and beaten up, recognize that we've been here before. and recognize that this represents a major buying opportunity in my view. Having said that, I also was talking about it last year as a major buying opportunity, and so it's not been too pleasant on some stocks. But you know, I take the Warren Buffett approach: accumulate things when they're good value, and then when they start going up in price, just sit back and let it run its course. And I think we have a long way to go in these mining stocks, and that's what this chart is saying. Once we take out this downtrend line that's been in place for the past 10 or 12 years, then we'll know that we have to start watching, and you may want to stop buying. But up until we take out that downtrend line, you want to continue to accumulate, because all of these things represent tremendous, tremendous value. I want to just wrap up with one more chart. This is the gold price going back, and I just want to draw attention, going back to the point I made at the beginning by calling things by the right name. You know, people talk about gold's bear market from 1980 to whatever, 2000. It wasn't really a bear market. It was a long-term consolidation in a major bull market that started back in the 1960s. See that green line there that I just drew? All you had was a consolidation of those huge gains. But here's what I would really want to draw your attention to. Look what happened back in the early 1970s. When gold starts moving, it moves for a reason, monetary problems, whatever it happens to be. And it will move for quite a period of time. See how it pulled away from that green line? And then it eventually came back. Not only did it do it once in the 1970s, it did it twice in the 1970s. Now, what I want to draw attention to is over here on the right-hand side of the chart. See that green line? But in order to make my point, I've got to change the scale. Why can't we see another one of these? And you can see that gold could very easily go to $2,000, $3,000 an ounce here in the near term. And by near term, I'm talking 2 years. Given the monetary problems that we have unfolding, the crisis that I'm expecting this summer with regard to the dollar, or not this summer, it's going to happen sooner rather than later, a higher gold price to me seems inevitable. I just want to wrap up with a couple of conclusions and a couple of quotes. We've got severe problems with the US dollar. As I like to say, it's on the road to the fiat currency graveyard. Unless it gets off this road, sooner or later it's going to get there, and I think it's going to get there sooner rather than later. We're seeing a flight from the US dollar. The demand for the dollar is dropping. People would rather own tangibles because they don't have counterparty risk, they don't have inflation risk, they don't have government risk, they don't have central bank risk. They want the peace of mind of knowing that their wealth is secured. And after all, at the end of the day, that's what it's all about. You want to sleep well at night knowing that you and your family are protected. And there's no better way of doing that than owning tangible assets rather than being reliant upon someone's promise. Money is fleeing into tangibles of all forms because there's no counterparty risk. And one important point, we all know that gold is an inflation hedge, but it's also a catastrophe hedge because it doesn't have counterparty risk. And this aspect of gold, I think, is going to become increasingly important as we see more Bear Stearns over the next at least several months. This year, I've been saying, is a lot like 1974. Just when you thought it was going to get better, it gets worse. And it gets worse, and it gets worse, and gets worse. And I think that's what we have to look for the rest of this year. Gold price will rise over the course of the year, but keep a proper perspective. It's really the dollar is going down rather than the gold price rising, because you still have that consistency in gold's purchasing power. And gold is going up or rising in dollar terms because gold is money, whereas the dollar is just a money substitute. And I'd like to end with two quotes. The first one from Ron Paul. The greatest threat facing America today is not terrorism or foreign economic competition or illegal immigration. The greatest threat facing America today is the disastrous fiscal policies of our own government, marked by the shameless deficit spending and Federal Reserve currency devaluation. This is sort of a paraphrase of a quote that's famous by Keynes, where he was quoting Lenin. There's no better way to destroy a society than by debauching the currency. And it's as true back then, as true today as it was back then, when Keynes was writing about it in the 1920s. The last quote, our finances will never be brought into order until Congress is compelled to do so. Making our money redeemable in gold will create this compulsion. This was said in 1948 in a speech given by Howard Buffett, father of famous Wall Street financier Warren Buffett. And the key point here ties into what Edwin was talking about this morning. Until we have redeemable currency, where a money substitute is tied to a tangible asset like gold, is imposed by the discipline of a tangible asset like gold, instead of we the people controlling the government will control we the people. Ladies and gentlemen, thank you very much.